Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. So far this year, there have been plenty of big events impacting financial markets. The war in Ukraine, soaring inflation, rising interest rates here and abroad, COVID wave, zero tolerance in China, 2 new prime ministers in the United Kingdom, one here in fact, and that's not even a comprehensive list. So, how do investors look through all of that? How do they ignore the volatility and the angst to find the opportunities? This, of course, is general information only, and you should seek professional advice before making any investment decisions. Brian Han is a senior equity analyst at Morningstar. Brian, welcome to Fear and Greed.
Hi, Sean. Thanks for having me.
How do you avoid the short-term anxiety? I mean, you make the point that the market actually isn't that far off pre-COVID levels, so we should be thinking about this long-term. That's easy to say, hard to do sometimes.
It sure is, and that's why I guess we have our job to convince people that there is merit to long-term thinking. But Sean, as an economist in your previous life, you would appreciate that we are all supposed to act in a rational way when making decisions. The funny thing is, in financial markets, a space where you'd think rationality should prevail most of the time, the exact opposite happens in practice. This is a world where when something gets expensive or has gone up a lot, people actually want to buy that thing even more. And when something gets cheap or has gone down a lot, people want to sell that thing even more. But that's where, Sean, I think investment opportunities arise, because assuming that you have a pretty decent handle on what a stock is intrinsically worth, stocks that are being sold off below intrinsic worth, on extrapolation of negative news and emotions, that provides you with a chance to buy them at a discount. And then you let the magic of compounding and patience to do the hard work for you longer term.
Okay. So, I mean, if you just take the fundamentals here, you need a strategy when you're investing, and it should be a long-term strategy, Brian?
Definitely.
Okay. And you sort of somehow need to ignore the noise.
Definitely. And that's where I come back to that point about getting a very good handle on what a stock is intrinsically worth based on longer-term, sustainable mid-cycle earnings, so that you let the stock prices provide you with the opportunities daily, whether to buy or sell relative to that intrinsic worth.
Yeah, I mean, in a way, that's kind of simple to think about that way too. It has a value, and you know that it's trading below or above that value, and that should guide your decisions.
Definitely, but as you sort of imply, it is easier said than done, because as the name of your podcast suggests, fear and greed plays a very, very big role in our markets.
Okay, now I'll get to a few specific stocks in a moment, but I just want to talk about something that you have spoken about previously, the top-heavy composition of the ASX 200, and the fact that the industrials, the big 3 iron ore miners, big examples of that, and the banks really do make up a lot of the market, fair few healthcare companies too.
Definitely. So I know there's a lot of angst in the market and worries, but the market is down only about 4% this year to date. And it's actually flat from pre-COVID levels. So, Sean, if you had gone to the Amazon jungle with no access to the internet just before COVID and just came back, you would be thinking, what's all the fuss? But if we actually drill down a little more on this year's market performance, it's really the technology, real estate, and consumer discretionary sectors that have dragged the market down. As you mentioned, sectors such as banks, resources have held up very well, and even the healthcare sector is only down about 5% this year. And these 3 sectors account for about 60% of the market's weighting, and that explains the resilience of our market this year.
Stay with me, Brian. We'll be back in a minute. I'm speaking to Brian Han, Senior Equity Analyst at Morningstar. Okay, so let's put all this together. Let's look at some of these sectors that have been sold off, and if we have a fundamental valuation for them, the idea that some of these stocks in these sectors actually are buys at the moment. And again, we just repeat to listeners that you should go and seek professional advice anytime you're buying stocks. The tech sector, where are the opportunities in that?
Yeah, unfortunately, in the Australian context, there are not many pure technology stocks, but there are pockets of value right now. I mean, one example would be WiseTech, ASX code WTC. We think it's worth about $70 per share. Current stock price is around, I think, 50.55. Now, for those who don't know, it is a software provider for the logistics industry. And it's actually a real Australian success story that is now playing on the global stage. You know, it has 6,000 customers, including, I think, 19 of the top 20 largest global logistics companies, such as FedEx. It has a very large global addressable market, a strong balance sheet, and a very large recurring revenue base. And one thing I say, though, Sean, is that once customers start using WiseTech software, it is very hard for them to switch, not only because the product works well, but because it's very hard to disentangle your system to that software. And, you know, it has a customer retention rate of 99%, which is not bad in anyone's language.
Yeah. Okay. So that's another sector you mentioned a moment ago, the REITs, the real estate investment trusts. I know you're a bit of a fan of Dexus.
Yeah, Dexus, and I would probably put Mirvac in that same bucket. It's trading at a 20 to 30% discount to what we think they are worth. I mean, they both develop, own, and manage a very diverse portfolio of properties across the office, retail, industrial, and even residential sectors. And their properties are premium quality, has very low vacancy rates. Now, rising interest rates are a headwind, but their balance sheets are very strong, and they both have very strong pipeline of developments. And they should also, especially Mirvac, should also benefit from this shortage of dwellings in Australia, especially when migration returns as COVID restrictions fade.
Yeah, okay. And another interesting one you've mentioned recently in the consumer discretionary space, another sector that has been sold off, is InvoCare, which of course is the provider of funeral services primarily. They've got a bunch of names under them, and they've wrapped that up into InvoCare. You think that's not a bad buy?
That's one of the real mysteries of the market, in the sense that we should be chasing after defensive stocks. And I don't think you can get any more defensive than a funeral provider. As the saying goes, there are two things certain in life. Tax is one of them, and the other you can sort of guess now. Yeah. But we do think that the company has suffered from overspending pre-COVID, and those investments not returning their requisite returns subsequently. But fundamentally, we think it is a solid business and a very recurring, very resilient earnings. So we do feel that there is value in that stock.
Okay, so let's talk about some of the sectors that haven't done so badly and whether there are still opportunities in those areas. Energy, I want to take you there because we have seen some phenomenal, the coal companies have done phenomenally well. Whitehaven, New Hope, for example. Woodside, another obviously much bigger company now since it purchased the oil assets of BHP. Have they had their run, do you think, those sorts of companies, or is there still room for them to do well?
We do believe that the likes of Whitehaven and to a lesser degree Woodside have had their run, even though Woodside is still about 10% discount to what we think it's worth. But Santos and Beach Energy, we believe they are still showing very good value at current prices. As you know, oil prices have surged, but we think they are likely to stay elevated. And for Santos, we think the market is undervaluing all the new oil projects that it has in the pipeline, and the current production growth is very strong, and the same can be said for Beach. Now, for Beach, sure, the production life of its oil projects are shorter than Santos, but we think the current stock price already more than discounts for that.
Okay. I have to mention, because so many of us via our super funds, if nothing else, invest in financials, the big banks, and also the big three miners. So if we take the banks first, Is it a case where you buy one bank, it doesn't matter which bank, you just go with the sector, whether it goes up or down, or are there opportunities within the big four? How do you think about it?
We do feel that you can discriminate between the banks. For instance, Commonwealth Bank always historically trades at a premium to the other three banks because of its market position and because its IT system is just far superior to the other three. But therein lies the opportunity, because when you look at Westpac and ANZ, both are trading at a discount of around 20% to our analyst valuations. Now, there are understandable worries about the property market, what it means for bank earnings as interest rates rise, property prices collapse, and mortgage payments get strained. But both these banks are very well capitalized and well equipped to handle any downturn, assuming that we don't have a early 1990 type of collapse in properties and employment. And we should also remember that rising interest rates are actually beneficial to bank earnings in the near term, because the spread they earn on those loans and the interest they pay on deposits, they get larger.
Yeah.
And of course, there's still a lot of cost to cut in these banks. I mean, you look at any bank earnings releases and efficiency improvement is still top priority. And we all know what that is euphemism for.
Yeah, we do. Just finally, the big three miners, obviously they rise and fall on iron ore prices, particularly Fortescue, since it is leveraged very much to iron ore. BHP is more diversified. I mean, Rio is too to some extent. How do you think about those guys?
I think, Sean, you struck right at the heart of the matter. It is all about commodity prices, and our analysts have a mid-cycle commodity prices, longer term, sustainable prices that are way, way below current spot market prices. And therefore, we do feel that there is a bit of an extrapolation of the current commodity prices forever into the future, thereby elevating the stock prices of these things. So we would be careful about investing in resources companies at current prices, just like smart people would have told people at the height of the pandemic digital mania that, you should be careful about investing in those stocks at those levels. And lo and behold, 1.5 years later, FOMO has become JOMO in terms of joy of missing out on those digital names.
I have never heard of JOMO. There you go.
Well, you took it from me, Sean.
Fantastic, Brian. Thank you very much for talking to Fear and Greed.
Thank you, Sean.
That was Brian Hand, Senior Equity Analyst at Morningstar. This is the Fear and Greed Daily Interview. Remember, you should get professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy the day.